The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Confusion, chaos, opportunity. Live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. A lot to dig through today as things calm down just a little bit here. All right, so the S&P 500 has risen only 3 times since the April 2nd tariffs were announced. And this advance today, up 1.2%, is the smallest move up in that period. You have Treasury yields falling for the first time in 1 week. Remember, the 10-year sold off for 5 days straight last week. The 10-year now at 4.35%. The dollar, however, continues to falter. The dollar index holding near a 6-month low, and we're keeping an eye on oil prices bouncing around today, at one point dipping below $61 a barrel.
Stocks also bouncing around today. You talk about that 80-point gap up that we had at the market open. That was tariff relief optimism, but by noon, those gains had been completely erased. We were down in the red, and that was the economic pessimism. We're now bouncing around in between those two, specifically after that monthly New York Fed survey crossed the wire in between those 2 time points. A showing in that report that almost a third of U.S. households expect to be in a worse financial situation from a year from now. Their outlook for income growth, their outlook for access to credit, their outlook for stock market returns, all dropping as their expectations for the cost of groceries, rent, and other items, all of that is rising. And this becomes the danger right now. Unanchored economic expectations among consumers now intersecting with relatively anchored investor expectations as investors try to snap up whatever bargains they can. But one big difference coming into this week versus last is that the markets, unlike the consumers, now have some confidence that there is indeed a White House put, a potential floor on asset prices. We're going to hear a little bit later on the program from the Treasury Secretary, Scott Bessent, who many speculate was the catalyst in curbing last week's bond rout. As of today, one bugaboo remains the dollar. A Bloomberg index of USD performance versus a basket of 10 peers, sliding for a 5th straight day, now down 7% from a year-to-date high, and more importantly, moving against the grain of direction to which other asset classes point. And should you be concerned? That is the question. But it really depends on whether you see the sell-off as more technical or fundamental.
So structurally, I do think that there is going to be continued pressure on the dollar, and we may be past that peak in U.S. exceptionalism. But the price action last week really screamed to me more technically oriented than anything else.
Kelsey Barrow, there, Scarlett, speaking a little bit earlier, we talk about the direction of equities. You can't really determine that direction without having some sense of where yields are going and where the dollar might go.
Right. How on earth do you begin to price equities? So let's dig into that divergence by looking at the dollar versus U.S. Treasuries. And usually the bond differential between countries is a key driver of FX. Money tends to flow to where it can get the higher yield. Take a look at the lines here. The dollar, which is the blue line, and yields, which is in yellow, moving in tandem for much of the past 12 months. But since April 2nd, and we'll go right here to the far right part of the screen, the dollar has tumbled along with bond prices, pushing yields up, showing that investors are fleeing both assets. Now, one explanation is perhaps a loss of confidence in the U.S. as a destination for funds. The chaotic rollout of tariffs may be causing people to doubt U.S. government bonds as the risk-free instrument and ultimate haven that they've long been. Romaine?
Particularly coming off of that volatility that we saw last week. Volatility somewhat muted to start this week, but remember, a holiday-shortened week here in the United States, bookended, of course, by the Passover holiday that began on Sunday, and Good Friday, of course, which is up ahead in about 4.5 days. Mike Contopoulos joins us right now here on this Monday afternoon, Deputy Chief Investment Officer over at Richard Bernstein Advisors. And Mike, when we look at the turmoil last week in the fixed income space and the relative calm that we have in the aftermath of it, a lot of people are saying that, okay, maybe that White House put or the Bessent put, depending on who you believe was behind it, maybe that actually does exist.
Yeah, I think it exists to some degree, Romaine. The problem is you've created so much uncertainty now in Washington. I think it's going to become really hard for, CEOs and CFOs to plan investments going forward. And so, we talk a lot about the tariffs and the effects of the tariffs on earnings and confidence and things of that nature, but we haven't, I don't think, spent enough time talking about just the uncertainty out there. And the uncertainty isn't going to go away. As we've seen, the policy is changing left, right, and center. And I think that's going to be the bigger, long-lasting issue amongst corporates and for profits and probably consumer spending as well.
So how difficult is it right now to even make a directional call? I mean, look, if you're a trading shop, you're doing great because you don't really care on a day-to-day basis. But if you're a longer-term investor, this matters.
Yeah, I actually would take the other side of that, Romain, a little bit. I think as a longer-term investor, it's probably easier. We focus very heavily on profit models. And with profits, you do have some amount of insight into. And we were hitting a profit peak probably in Q2 or Q3 of this year, regardless of what was happening with tariffs. Now that's probably brought the peak a little bit more forward. So you're looking at Q1 or Q2. But I think if you're looking out over a 6-month or 12-month horizon, things are actually pretty clear. You're headed towards deceleration, not acceleration.
What is your game plan if companies indeed end up pulling their guidance, as we pretty much expect them to, or maintain their guidance but say it excludes the effect of tariffs?
Yeah, I think, when we looked at going into this year, as I mentioned earlier, I think, we were approaching a profit peak regardless of tariffs. The direction of our portfolios is clearly to get more defensive over coming, weeks or months. I don't think there's a huge rush to that, quite frankly. You never want to make rash decisions in the, moment of high volatility. And I do think Q1 earnings are likely going to be pretty strong. And that could also cause a little bit, that plus what we hear out of the White House, put a little bit of a floor on markets near term. So I don't think there's a huge rush to get max defensive here. But I think when you think about, later Q2, Q3, and into Q4, you probably are going to want to have a defensive posture.
So Romain mentioned the White House put, the Trump put. A lot of people are wondering whether there's a Fed put as well. We did hear from Susan Collins, the Boston Fed president, last week that the Fed would step in to stabilize the markets if necessary. According to UBS, the Fed would be looking at investment grade spreads moving about 200 basis points above treasuries and junk bonds about 720 basis points before the Fed actually makes a move. Is that the key benchmark here for credit markets to blow out, the spreads to blow out before the Fed steps in?
Well, that's a great question, Scarlett. So I think there's a couple things we need to focus on. If first of all, if IG gets to 200, high yield's going to be well north of 750, in my opinion. That means you're in basically a recession. And certainly when you're in a recession, I'd expect the Fed to cut interest rates pretty meaningfully, not just because of the credit component, but because of what's probably happening with unemployment as well. I think funding markets drying up would be a big issue. If the plumbing of the financial system starts to gum up, then they might step in. But I think that Fed put is much higher than what people expect, or much more out of the money than what people expect. I think the inflationary backdrop is going to be such that it really kind of puts them between a rock and a hard place. And unless you see unemployment skyrocket, I think that's really the measure, or the financial plumbing really gum up, I would not expect the Fed to come in and save markets here.
Did you see any evidence last week that financial plumbing was in danger?
In the swaps market, maybe a little bit, but not extraordinarily so. I think it's still got a ways to go before you see something from the Fed, like a QE type sort of response. And in fact, I think you would see the Treasury probably step in and increase buybacks before you saw the Fed do anything. So, listen, I don't think we're there quite yet, Romain. I think it's still got to break a bit more than what we saw last week.
So then on the inflation side, I mean, obviously looking at survey data, which continues to show, at least on the household and consumer side, some pretty wild expectations, 5, 6, 7% inflation rates, obviously a lot different than what the actual financial markets are pricing in. Yep. When does that difference in expectations become a concern?
Well, you start to see these big divergences between a lot of the survey data and the market-based data. That's not infrequent, and that happens quite a bit. But if you look at like 5-year inflation expectations, it is quite high, right? And on a historical basis, it's quite high relative to where we have been over the last 10 years or so. I think that is a concern today. When you look at inflation expectations via the markets, when you look at survey expectations, and when you even look at some of the hard data, it's not good. So I would say that should be a concern of the Feds today. That should be a concern for investors today. It has implications with how you invest in the long end of the yield curve. I don't think yields will fall quite as much as they have in the past in the 20 and 30-year space, even as unemployment goes up, should that happen later this year. And you probably see a steeper yield curve.
Staying on what investors should worry about today, can you give me a sense of how you're listening to comments coming out of the Trump administration, whether it's Navarro, Bessent, or Lutnick, to gauge what the thinking is, or at least what the strategy behind that is?
Yeah, so I don't know if I'm 100% convinced that there's an incredibly well thought out strategy amongst the administration. I think they know what they want to do, but are certainly kowtowing a little bit to markets. And I think President Trump basically told us that when he said that he rolled back tariffs because people were feeling jittery, I believe was his
yippy,
word he used. Yippy. That's right. That's the technical term. And so I think he told you right there that whatever plan they may have, similar to what Mike Tyson said, right? Everybody has a plan until you're punched in the mouth. I feel like the administration's sort of like that. So we can only guess what the long-term plan is for the administration. And that's why I think it's dangerous to try and trade or position a portfolio simply based off of politics without paying attention more to the fundamental drivers of earnings and liquidity.
All right, Mike, got to leave it there. Great conversation. Mike Contopoulos, Deputy Chief Investment Officer over at Richard Bernstein, kicking us off to the close on a day with stocks right now near the highs of the day. Yields right around the lows, and the outperformer, at least in the equity space, you're going to find that amongst financials. Goldman stock traders notching record revenue in the most recent quarter. A look ahead to some of the other big bank earnings out later this week and what to expect, including from Citigroup.
Plus, we've seen tech losing some steam, but Apple roaring in today's session on Trump's latest tariff exemptions. A look at how to trade the sector through all this turmoil.
And is there a White House put? An exclusive interview up ahead with the Treasury Secretary of the United States, Scott Bessent. Going to be sitting down with our Anne-Marie Hordern on his trip to Argentina. All that and more coming up in just a bit, right here on The Close. This is Bloomberg.
Shares of Goldman Sachs rallying after the firm's latest results beat analyst estimates, with stock traders posting their highest quarterly revenue haul on record. So here now with more insight on the financial sector as banks continue to report their results this week is Jason Goldberg, senior analyst over at Barclays. Jason, what surprised you the most about the earnings that we have seen so far?
Yeah, I think the biggest upside surprise has come from better than expected equity trading revenues, with several of the banks posting, record quarters. That was certainly a bright spot. In addition, share repurchase continued, unabated. You've actually seen an uptick since the fourth quarter, despite kind of several of the uncertainties. And then importantly, credit quality indicators were fairly benign. Now, maybe a little bit backward looking in light of some of the tariff news we've gotten, but, loan losses, were stable to lower. In non-performing assets, generally, relatively stable. And while banks boosted loan loss reserves a little bit, it certainly wasn't by any, big increases.
Okay, so the bottom line is banks believe the health of their customers, whether it's corporate or individual consumers, remains fairly sound, even with a lot of warnings about the economy. You mentioned the equity trading, Goldman's equity trading desk clearly benefiting from all the volatility. A question did come up on the earnings call about good volatility versus bad volatility. How quickly can good volatility turn into something bad?
It certainly was very good in the first quarter, and so far in the second quarter, it feels like results continue to be good. I mean, volumes really across all asset classes are robust as, institutional investors continue to navigate the evolving landscape. It's obviously something we watch, but, so far, despite all the volatility we've seen, trading has been fairly orderly, both in the equity and fixed income markets.
There was a lot of questions on the conference call, Jason, about sort of the potential pickup in capital markets later this year. How much, confidence do you have in the comments that they gave? And more importantly, what is your own personal view as to when we can see a material jump?
Yeah, no, backlogs, and pipelines remain, quite robust. Clearly in the near term, there's a lot of uncertainty, whether it's tariffs or taxes or immigration or whatnot. And I think corporates are kind of, waiting to see how some of these policies break or engaging in either an IPO activity or M&A activity. But there is a lot of pent up demand. And our sense is once we get further clarity on both the kind of the tariff outlook and the economic outlook, there's a lot of transactions to be had. I mean, corporates, need financing, and there is a lot of strategic rationale to consolidate across various industries. And I think once people get a better sense of what the new administration's up to, you'll be able to see those transactions materialize.
It's interesting, too. I mean, we talk about, obviously, the rally that we're seeing in Goldman and some of the big banks. Obviously, the sort of diversification of those banks really sort of helps in situations like this, a pickup in trading while investment banking is down. For those banks that don't necessarily have that same diversification, take M&T, which reported earlier today, clearly some outsized exposure to any potential drop in consumer lending. Also, of course, that drop in net interest income. What is the ballast for them going forward?
Yeah, no, that's a good point. I mean, I think, you've seen that kind of the biggest banks report so far. And I think to your point, right, trading revenues are 3 to 4 times that of investment banking fees. We'll get a lot more regional banks as this week progresses. And they don't have the benefits of trading. So, loan growth has been, still fairly subdued this quarter. You're seeing some benefits from lower deposit costs, but also as variable rate assets reprice lower, there's some headwinds there. Net interest income had 2 less days this quarter than last quarter. So, for the more traditional banks, results may not be as strong as we've seen, Friday and earlier today.
All right, Jason, great stuff. Jason Goldberg, senior analyst over at Barclays, to look at a couple of the bank earnings we got earlier today, and of course, a push ahead to Citigroup and a few others starting tomorrow. When we come back after the break, a focus on the retail sector. This after we got earnings out of LVMH, and sales in the most recent quarter, they were weak, fueling some concern about a broader luxury goods market under pressure amid all the tariff uncertainty. Jelena Sokolova going to be joining us, senior equity analyst over at Morningstar, to talk a little bit more about what she expects going forward. That's coming up next here on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Apple. KeyBank raising its recommendation to sector weight from underweight. This after President Trump temporarily exempted phones, computers, and chips from tariffs. The analyst says the exemption is probably the, quote, best case scenario for Apple as it takes a big risk off the table. Investors willing to take a risk on Apple on the day, up for a second day, a 4% gain here on this Monday. Up next, DuPont. Another call from KeyBank upgrading the chemical company to overweight, saying that the tariff relief for Apple actually de-risked downside for DuPont. Adding to this, KeyBank says DuPont's strong balance sheet should help it weather any economic downturn. Those shares rising for a second day as well. And finally, Brunswick Corp. You know this as the home of some of the most well-known brands of boats. Truist Securities, though, cutting its price target to $60 from $85 ahead of the company's earnings next week. This as recreation stocks overall begin to feel the impact of tariffs, with consumer spending under pressure. The analyst saying that the recent sell-off for the stock appears to have largely discounted potential tariff risk, and says that because of that, further downside could be around the corner. Nevertheless, the share is getting a modest bid, up about 0.4% on the day, though we should point out the stock's still down more than 30% to start the year. In terms of consumer spending, well, we're also keeping an eye on, well, one of the granddaddies of them all in the luxury space, LVMH. Shares going on a bumpy ride throughout the day. This after their 1Q earnings report showed a drop in sales, a drop that was more than what the street was looking for. The company's weak sales now fueling concern for the broader luxury goods space, particularly with names like Kering and Hermes set to report a little bit later this week. We're joined right now to talk a little bit more about this by Jelena Sokolova. She's an analyst over at Morningstar, where she covers the luxury goods sector. And let's start off with the numbers from LVMH. They weren't awful, Jelena, but I am curious as to whether we can take this one quarter and maybe extrapolate that there is a longer-term trend here at play of weaker growth.
So the numbers were a deceleration from Q4, which was quite strong for them and for the sector. So some deceleration was to be expected. But the interesting thing about it was that it was not driven by the U.S., but it was predominantly driven by Chinese spending less, essentially in Japan. So for fashion and leather, which is their biggest division. The disappointing factor is, of course, that the weakest numbers rather are for their most profitable two divisions, so wines and spirit and fashion and leather. Of course, there is also potentially a negative read across to the whole sector with these results. Yeah. And also with the market turmoil, it could weigh on luxury consumer sentiment.
As far as its sectors, I mean, can you talk a little bit more about wines and spirits? Obviously, this is one of the sectors that's definitely much more exposed to the tariff impact than some of its other sectors here. What do they have to say about navigating through this?
Yeah, so essentially, wines and spirits is, of course, more also, it's quite a cyclical business, right? It's also predominantly exposed to wholesales, which makes it more tricky to navigate the inventory situations. And it is also exposed to more aspirational consumers, and here pricing may be also more difficult. So for this segment, the recovery could be quite gradual.
Jelena, you talked about the faltering Chinese demand. The disappearing Chinese consumer, do we know whether it's a pullback on everything, on all brands, or are they shifting some of their spending to local brands, to Chinese brands?
I haven't really heard about specific. Well, there's quite not many of established Chinese luxury brands. There is a trend to shift towards domestic, say, sports apparel brands, but we don't really see that much in luxury. But Chinese, as also other nationalities, are more resilient with companies like, for instance, Hermès, which are more exposed to more affluent consumers, but also with companies like Moncler that has been outperforming in this market with exactly this, more sporty positioning.
Right, and I'm glad you bring up both those names because Moncler and Hermès set to report later on this week. Of the brands that you cover, which has the most pricing power and the ability to withstand, this slowdown in demand?
Yeah, I would say Hermès definitely stands out in terms of pricing power. They have been also less aggressive, in immediate aftermath of the pandemic in raising prices. So they have been quite careful, and now they are executing. They're basically exercising this pricing power. But given that their brand standing is really exceptional, they don't really have direct competition in their price ranges. Their pricing power is stronger, and they're also exposed to more affluent consumer, which is a little bit less price sensitive.
All right, Jelena, thank you so much. Jelena Sokolova, senior equity analyst at Morningstar, on the heels of LVMH's results. And of course, Moncler and Hermès set to report later on this week as well.
Well, that's what I'm curious about, too. I mean, because anytime you see these types of numbers or type of forecast from a company like LVMH, you wonder, is this specific to that company or is this a broader trend? And hopefully we'll get more clarity on that on April 17th.
What struck me, though, was that the revenue for fashion leather goods at LVMH fell 5% on an organic basis. Analysts were looking only for a decline of 0.55%. I mean, that's a huge gulf.
Well, and it's hard to sort of model this now. I mean, we had a retail analyst on maybe about 3 weeks ago, and she was saying kind of this is the problem now, is that because so many of these goods are sold not just through the normal retail channels, as Jelena was saying, the wholesale channel, then you have the whole travel aspect that a lot of their goods are bought in airports and duty-free shops and things like that. I was in a duty-free shop just this past weekend.
And?
I picked up a couple things,
Did you?
Rum cake, rum candy. Oh, and some cigars.
And you happily brought it back
Which I don't think I was supposed to bring back, but they're here nevertheless, Scarlet Fu. You're more than welcome to one if you'd like.
All right, I'll take you up on that later on. Coming up, we're going to speak with Dan Niles, founder and portfolio manager at Niles Investment Management, about the moves that we're seeing in Apple after the White House temporarily exempted smartphones, computers, and chips from his tariffs. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Scarlet Fu. And you saw how clear it was outside. It feels like there's some clarity on markets, at least this afternoon, because things are moving in one direction.
Yeah, it'll be interesting to see, though, how this holds, too. I mean, we talk about a market that has still been decimated by, obviously, a lot of the policy chaos coming out of Washington. 5,400 in the S&P on the day here. I mean, the good news is you get this two-day rally, if you will. The question is, how much further does that go? And not to throw water on it, but also we should point out, too, volume definitely below where it was. Basically a holiday week for a lot of folks, of course, with Passover that started over the weekend. And then, of course, you have Good Friday and Easter coming up this weekend. So a lot of people away from their desks.
Yeah, I'm looking at volume in the Dow and the S&P off about 40% from their 20-day average, or 5-day average, I should say. So really a slowdown compared to what we had seen recently. Yeah. And, of course, if you look at Apple shares, that's a big, interesting one, given the U-turn on tariffs and then the mention by the president that, of course, he's still thinking about sectoral tariffs.
I'm so confused by this too, because I was away for a couple days. So first we knew that Apple was kind of in the center of this storm because of their supply chain, their customer base. Then apparently there was an exemption for iPhones and other things, smartphones.
Laptops,
but then
chips.
Then Lutnick and some other people saying there wasn't an exemption, or is it temporary? So I'm very confused as to what exactly is Apple paying right now in terms of tariffs, or are they going to have to absorb on tariffs, because it's not really clear to me.
Well, it sounds like they moved a lot of their stuff into the U.S. right before the April 2nd announcement anyway, so they can work off of that inventory. But these are all good questions. So for more on how to think through a lot of these questions, let's bring in Dan Niles. He is founder and portfolio manager at Niles Investment Management. Dan, how much is Apple caught in the crosshairs of what the administration is doing or not doing? Can anyone really make a call on a company when we have no idea how to interpret the latest moves?
I think you framed it perfectly, Scarlett, which is why I think you have to go back to valuations, right? Because there's two components to a stock price. There's earnings, which we have no idea what those are going to be, because on a daily basis, where we are on tariffs changed, right? The second part, though, is the multiple. And that you can look at it relative to what you're paying for other names in the space or the market in general and go, okay, what's the risk I'm taking owning Apple relative to other names? And so if you look at the S&P, for example, you're paying 23 times trailing estimates. And the reason I look at trailing is the forward numbers are clearly too high. And we've been saying this for a while. Right now, the S&P estimates are for 13% earnings growth. Hopefully it's something closer to the low single digits and not negative. But, for Apple, obviously the numbers are too high as well. But if you look at 23 times for the S&P, why would you pay 33 times for Apple? It makes no sense, especially when you go on a fundamental basis. The AI upgrades to Siri have been pushed out from this year to next year. The growth for the last 3 years in revenues combined is 5%. And you can buy a lot of other companies in the Magnificent Seven for a lot cheaper. The thing is, Apple's a retail darling, and so on days when the stock market is up, investors tend to gravitate towards that because a lot of people have iPhones in their pockets, and they're going, market's up, let me go buy some Apple.
Yeah, well, and of course, a lot of people going to Apple stores over the past few weekends to load up on iPhones before they think prices are going up. This earnings season, a lot of questions obviously will be focused on the supply chain and how these companies are moving them or adjusting them or rethinking them. What about AI spending, the theme for the last couple of earnings season? Will that come up at all, and will that move the needle for investors?
Yeah, I think it will. And I think you said something really interesting, Scarlett, which is the guidance probably is not going to be as bad as it should be for the simple reason that you said earlier, which is people are walking into stores and stocking up on iPhones before tariffs drive the prices up. And if you look at it this morning, we got March export and import numbers from China for the month of March. And exports from China were up 12.4% year over year. The consensus was up 4.6%, so much bigger than what everybody was expecting. And the imports were down 4% year over year versus the decline people thought of 2%. In addition to that, you had Easter move from the end of March last year to April 20th this year. And so that's also going to make demand look like it's better than it normally should be in the month of April. And so I think companies may end up guiding a little bit better than they should have. And then this pull forward in demand is going to cause an issue. With regards to your AI question, we've been writing about this for a while, but you're having companies going from spending being up about mid-teens on a sequential basis for all of 2024. That number probably drops to mid-single digits based on the guidance we've gotten so far for the first half of 2025. And so I think you're going to go through this AI digestion phase. I know you've talked about Microsoft cutting back on contracts as a good example of this, but I think you're going to see more of that in an economic environment that's tougher.
Do you think, though, that might actually be embraced by investors, Dan, particularly given that there was some concern that some of these companies were spending maybe a little bit more than the return seemed to suggest?
Well, it's a great point, Romain. I mean, I think there's two elements to that. And this is one we've written about before, which is the most violent rallies happen during bear markets. So if you go back to the global financial crisis, you had 11 rallies of 10% each on average on the S&P 500, while you lost 57% on the S&P. During the tech bubble, you had 7 rallies that averaged 14% each on your way to losing 49% of your money. And this rally right now that we're having is up 9% or so right now. And so you're kind of getting into that 10 to 14% band, which is normal. And so you may have, the stocks go up a little bit more, which I think is possible. But here's the thing. If, let's say, Microsoft, Amazon, Google come out and ratchet back expectations for AI spending either for 2025 or 2026, that might be good for them because that means, you know what, their cash flows are actually going to get a lot better. But for the semiconductor companies associated with AI, that's not going to be so good. But I think in the near term, because of this pull forward that Scarlett talked about earlier, that's going to keep numbers from going down too much because everybody wants to get these chips before tariffs maybe drive those prices up even more.
So then what can some of these companies do to placate investors that maybe are concerned, raising the same concerns that you are, Dan? Is it basically throw some cash at them through buybacks or even dividends for those that do pay it? Or is there something else maybe that will keep investors tethered?
Yeah, I mean, I think the thing is that there's short-term and long-term. For the big mega cap names, generally, all of them have great balance sheets. And the best thing that they can do is not be stupid and throw money at buybacks, et cetera, when you might be facing down, which I think you will, negative GDP growth in either Q3 or Q4. Because during recessions, multiples compress a lot. Right now, you're running at about 23 times trailing PE on the S&P. In a normal environment with inflation this high, that it should be 19 times. If you're in a more recession environment, it's like 15 times, which means that obviously the market can go down 30% plus from here if you end up in a recession. And quite honestly, it can go down another 20% from here if you just get back to average trailing PE multiple. So to go ahead and throw money at stuff to try to support your stock, it's just not going to work. You're better off having a great balance sheet so that when you do end up with the ultimate trough, you can step in, buy some interesting technologies, do things like that, because that's what these tech companies should be doing. They're not people don't buy them for 3 to 4% dividends. They buy them for revenue growth.
Absolutely. Dan, we've got to leave it there. Always great insights. We'll let Dan get back to it. Dan Niles, founder and portfolio manager at Niles Investment Management. A closer look at the broader tech space with the Mag 7, posting another good gain on the day with Apple leading the charge amongst that group. But one of the biggest drags on that group is Meta. Those shares down a couple of percentage points right now. We're going to talk about it in our stock of the hour coming up after the break. This is The Close on Bloomberg. All right, let's take a look at shares of Meta. The stock down for a third straight day. This is Mark Zuckerberg taking the stand in court at the FTC's antitrust trial, which is seeking to break up the company. The FTC arguing that Meta's past acquisitions of companies like Instagram and WhatsApp actually gave the company an illegal monopoly on the social networking industry. Dave Lee is a columnist here for us at Bloomberg Opinion. He's written about this case, and he joins us right now here. All right, so Zuckerberg's down in Washington at this trial, answering a lot of questions. It's backwards looking, but kind of revealing so far. I mean, he seems to be kind of ratifying, I think, what's been reported for a while right now, is that Facebook was running scared for a while when it came to competition, particularly when it came to news and information.
Yeah, absolutely. I mean, look, this is a company that its survival depends on being the place to be to talk online, right? And so when you had a company like Instagram breaking through, and then you had WhatsApp as a messaging app breaking through, Facebook, and specifically Mark Zuckerberg, looked at those two companies and thought, well, we need to either swallow them up, or we need to copy what they're doing. And in the case of Instagram and WhatsApp, it bought both of those companies. And so now the allegation is that it did that to bury the competition. And that was what made Meta have its huge user base, which now numbers more than 3 billion people using it every day. So that's what's on trial here, the intent when they bought those companies.
What's interesting about all of this is that the tech titans have lined up behind the Trump administration. Mark Zuckerberg bought a house in Washington. He's been personally lobbying the president with trips to Mar-a-Lago. And it feels like these efforts are not exactly paying off because the FTC is just as focused on big tech as it was under the Biden administration.
Yeah, absolutely.
And we should point out, this case is a holdover from the Biden administration.
It is. Well, it's actually this case in particular is a holdover from the Trump administration. So, this has lasted all the way through, as some of the other cases have as well. But of course, when Biden was in the White House, he hired Lina Khan to be his head of the FTC, the Federal Trade Commission, and she was seen as this real sort of hawk on antitrust, and the tech companies hated her. They were trying to get her thrown off cases. They were trying to undermine her with various comments. There was a hope among the tech companies that once Biden had left the Oval Office, that Trump would kind of pull back. That doesn't seem to be the case. In fact, Andrew Ferguson, the Khan's successor in the FTC, said we're not going to take our foot off the gas. So, this lobbying directly to President Trump, going to the White House for dinner, standing behind him at the inauguration, doesn't seem to have really got them much as a result.
Just real quickly here, I mean, do we have any sense here of what the potential outcome of this case might be? Because we've seen these types of antitrust trials before, and as much as it seems like these companies and CEOs are in the hot seat, the end result is usually a lot of the same.
Well, it's dramatic, and then it gets drawn out and out and out and out for many years. Now, the worst case scenario, and what the FTC want to happen, is for Instagram and WhatsApp to be spun out of Meta. That would be a disaster, because Instagram is the biggest earner for Meta now. It owns more advertising than the original Facebook Blue app. I think we saw the stock a moment ago. It was down, 1.58%. I think investors thought that was a risk. That number would be much, much worse, right? And so I think there's an understanding that they think Meta's probably going to prevail, but then they said that about Google, and that didn't happen for them.
All right, Dave Lee, Bloomberg opinion columnist, thank you so much. And of course, we'll be checking in with you as the trial continues. Coming up on the close, we're going to take you to the closing bell with Dana D'Auria. She's co-CIO at Envestnet. This is the close on Bloomberg.
The direction of our portfolios is clearly to get more defensive over coming, weeks or months. I don't think there's a huge rush to that, quite frankly. You never want to make rash decisions in the, moment of high volatility. And I do think Q1 earnings are likely going to be pretty strong. And that could also cause a little bit, that plus what we hear out of the White House, put a little bit of a floor on markets near terms.
A focus on earnings, a focus on tariffs, and of course, that big focus on macro conditions. Mike Contopoulos kicked us off to the close over at Richard Bernstein Advisors. That was just about 50 minutes ago, Scarlett, and the markets are pretty much where they were when we started the show back then, not far off the highs of the day, green pretty much across the screen. Yeah,
Mike mentioned a floor to equity prices, and that's kind of what you're seeing right now, with the S&P holding on to a 1% advance or just around that level. 23 out of 24 bank names are also gaining, JP Morgan the exception there. And of course, we're keeping a close eye on tech hardware companies after the White House said they were exempting laptops, hard drives, chips, smartphones, and other electronics from the China tariffs and the baseline 10% tariffs, unless they impose sectoral tariffs, which could be coming at any point. Yeah, and of course, that is the big driver on the market today. Some of those hardware makers, some of the software companies as well. When you broaden it out from the S&P 500, a little bit more mix. You are seeing a lot of fintech names in there. A few, believe it or not, retail names as well, like Bed Bath & Beyond rallying here on the day. So investors are sort of trying to find, what in their mind would be a bargain given the big sell-off that we had over the last few weeks. It's also worth noting that the VIX declined to below 30 for the first time in a week. So again, more metrics showing that people expect some measure of calm for at least a few days. Also interesting, too, to see the competition amongst returns for various assets out there. Obviously, you get what you get potentially in the equity markets, but still some relatively decent yields out there in the fixed income space, despite the drop that we're seeing in those yields on the day. Let's get someone to help make sense of this as we move closer to those closing bells. Dana D'Auria joins us, Co-Chief Investment Officer over at Envestnet. And Dana, I mean, the big parlor game right now is that when you look in the face of the sell-off that we had over the past few weeks, and you look at this sort of, I guess we'll call it a mini rebound that we've had in 3 of the past 4 sessions here, does that give you enough confidence here that maybe it is appropriate to sort of look around and find those bargains?
Well, I definitely think for those who are looking to maybe rebalance to a risk tolerance that is more suited to them, now might be the time. So sort of a twist on the question maybe that you're asking. I think, look, we obviously deal with retail advisors and their client base. And, the issue, I think, for a lot of people coming into all of this turmoil has been that they may have been over allocated to equities, right? We were coming into this with this expectation of a pro-growth, pro-business type of a policy, a nice bull market ahead of us. And people were caught off guard for sure by the breadth and the depth of the tariff announcement. And so now that we've had the opportunity for stocks to come back, nobody likes, selling it when it's at a loss, even if they should. I think it does give people a little bit of a chance now to look at their portfolios and say, look, am I overly allocated to equities, or should I be thinking about paring back a little and something I can sleep at night for the next potential turmoil?
And of course, a big part of that, particularly when you're dealing with wealth managers trying to give advice, is the idea of not necessarily selling off your losers so much as taking some profits from the winners. Are those profits going back into stocks, or are they going into the fixed income space, locking in whatever yield you can get for the rest of the year?
Yeah, I think, for those who are already kind of over allocated to equities, I think for sure you want to use the opportunity to rebalance into, kind of the fixed income, the ballast side. I know, of course, we saw this big sell off in 10 years and kind of this concern, hey, everything's getting sold, everything's kind of going to cash. In the moment, that's true, or can be true, right? But over even a little bit longer time frame, if you zoom out a little, having that fixed income position in your portfolio is usually going to provide a good ballast. So I think, yes, for those who are kind of over allocated, it's a harvesting a little bit and a going into fixed income. Of course, we are seeing kind of cash, right? I mean, we're already really allocated to cash, trillions of dollars in cash. And that's only increasing now as people sort of look at this uncertainty and say, can I really trust what's happening here?
So as people hold on to cash and kind of look to position themselves for their eventual next move, what is your highest conviction trade right now?
So obviously there's, your standard marginal trade into something like a quality, right? When you're looking at a situation like this, and especially something like tariffs, you say, okay, go for non-discretionary, go for higher quality. Certain types of industries just hold up a little bit better, what you need, right? Healthcare, for example. I think that's a very marginal, and there's a lot of noise around trades like that. I'm more of the mind that you should be kind of getting to where, again, if not risk tolerance, also diversification. If you're concentrated, you were making big bets on tech or something like that, which would be understandable, from where we came. I think now's the time to be saying, okay, should I have some international in the portfolio? We came into this year, with this U.S. predominance, U.S. exceptionalism, et cetera, and I think we're kind of seeing the value of why you can't come into it that way, and you're better off being allocated internationally as well.
So that unwind from U.S. exceptionalism, how far into it are we? Are we, a third of the way through, 2/3 of the way through?
Well, we don't know, obviously, where we're going to land on these tariffs, right? And we, 90-day pause is 90-day pause, and let's be honest, we don't even really know if we can trust that. Yeah. So being able to do the math around, okay, which countries are going to be better off, which parts of the economy. I mean, we can exempt, an iPhone, but not exempt the parts of the iPhone, right? So it's very hard for the market to price this kind of thing and to say, hey, which countries and, at what place should we be? A natural, if nothing else, academic starting point is to be allocated at market cap weight relative to these geographies. And so if you're finding yourself way off from that, and, because of the last 10 years, U.S. is already a very significant stake. So it wouldn't, you're not allocating a massive amount of your portfolio to international, if you're just even starting with that market cap weight rule of thumb.
All right, Dana, good stuff. Dana D'Auria, Co-Chief Investment Officer over at Envestnet, helping us count you down to those closing bells here on this Monday afternoon. Green across the screen, Scarlett, a pretty broad-based rally, too, we should point out. Last time I looked, you had something like 450 of the S&P names in the green. But we also came in today with Citigroup kind of downgrading their overall view of where stocks are going to end the year, as a group, at least. And then you had folks like Bob Michael over at JP Morgan Asset Management kind of touting maybe the potential benefits of fixed income, because partly, at least in his view, there is, if not a Treasury put, there's certainly a Fed put in order to keep the Treasury market functioning. Yeah, but you might have to endure quite a bit of pain to get to that point again. Speaking of the Citi being the latest firm to downgrade U.S. stocks, I wonder just how much we're going to learn from earnings season this time around, because companies are going to be extremely reluctant to say anything when the goalposts keep moving. Yeah, I think so, but I think maybe sometimes silence can say more than actual words as well. So it'll be interesting to see which companies are willing, which CEOs are willing to go out there on a limb and make their thoughts known, and which ones maybe are going to be a little bit more tight-lipped about things here. We're not going to be tight-lipped with you. We're going to have a full breakdown of all of today's market moves, from stocks to bonds and everything in between. That starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Fu. Today, Alex Steele is off, helping taking you through those closing bells. The global simulcast starts right now. Carol Massar, Tim Stanovic, they are in the radio booth, and they join us as they do every day at this time.
I don't even
as
know
we
who
welcome
you guys
our audiences
are
across all of our Bloomberg platforms. Carol Massar.
Hello.
I've been gone for 2 days.
I know.
You're still talking over me. Did you actually stop talking when I was gone?
No, you can ask the folks. No, but there's been so much going on.
It's great to see you too.
Volatility in the markets. It's nice to be talking with you guys again. Up and down we went today as well, but I think many would say it's interesting to see at least some green across the screen and some movement to the upside, considering all of the volatility we've had over the last week and a half or so.
Well, that said, we are still seeing a little bit of a downturn as we do get closer to the close. The S&P 500 was up as much as 1.8%. It did fall as much as 0.1%. Higher right now by just about 0.8%.
Having said all that, things feel relatively calm, muted, normal compared to the last week and a half. The S&P has gained only 3 times since the April 2nd tariffs were announced, and today's advance is actually the smallest of those 3 gains.
Getting a boost, though, today from, of course, some of those big heavyweights like Apple up about 2%. That's your biggest point contributor here to the S&P 500. Some of the healthcare names like Lilly also doing their work. But then you had that drag from Meta, from Amazon, Broadcom, NVIDIA. In fact, a lot of the folks in the chip space really getting dinged, of course, after additional tariff headlines now saying that maybe chip tariffs are coming, which I don't know.
At some point.
I thought they were coming and they weren't, and maybe now they are. I can't keep up with anything here. What I can keep up with here are the closing numbers on the screen. You can put today's numbers in the book as we get the bells and the clapping and cheering that go along with it. A Dow Jones Industrial Average higher by more than 300 points, or about 0.8%. The S&P 500 looks like it's going to gain a similar amount on a percentage basis, roughly about 43 points, closing right above that 5,400 level. The NASDAQ Composite higher by more than 100 points, or 0.6%. But your gainers on today, you're going to find that your outperformers, on the day are going to be in that cyclical space. The Russell 2000 up 1.1%, S&P Midcaps up 1.2%, and Dow Transports clocking in at about 1.2% higher.
All right, back to the S&P 500 we go. And Romaine, of course, breaking down all of those closing numbers. But you got about 432 names actually in the S&P 500. Scarlett gaining some ground today, 70 to the downside.
All right, let's take a look at the IMAP, which shows the sector performances. And remember, on Friday, this was all green. Today, there's a slice of red, and it's in consumer discretionary. And just taking a look at some of the names, companies that certainly do rely on importing from, say, China, are among the decliners there. So which makes sense given everything we've heard about the tariffs.
All right, a lot of green. I had a lot to choose from. I want to go to, speaking of tariffs, we did see GM and Ford as well rallying in today's session. GM up about 3.5%, Ford a gain of about 4%. This is after you did have the president come out and said he was looking at helping car companies with tariffs. So a whole boost to the group. Stellantis also seeing some gains. Romaine mentioned and singled out Apple. This one at its highs today, guys, up about 7.5%, finishing the day, though, with only a gain of about 2.2%, but nonetheless to the upside. Again, we go back to the bigger, broader macro story of tariffs. President Trump's administration, of course, temporarily exempting phones, computers, and chips from its so-called reciprocal tariffs. So at least for now, they are spared, and that company's global supply chain spared as well. As we know, so much exposure to Apple when it comes to China. Let's all go to Intel. Romaine, you mentioned the stocks, and overall it was just a little bit higher as an index today, but you did have Intel up almost 3% in today's session. The company entering into a definitive agreement to sell 51% of its Altera business to Silver Lake at an $8.75 billion valuation. So again, Intel continuing to kind of remake its future, and so selling that off. And then I got to mention Fannie and Freddie. Fannie up just shy of about 9%, but was up as much as 14% earlier in the session.
What was the big news that they were tweeting about?
I don't understand that this is the news that gets it going.
Yeah.
Initially,
Pulte
there was
came out.
Right. Initially, there was a tweet. The Federal Housing Finance Agency Director William Pulte said in a post on X that news on Fannie Mae is coming shortly. We did get some news that Omid Malik, co-founder of 1789 Capital, joining the board of mortgage giant Fannie Mae.
Was that the big news?
I don't know. But keep in mind that company is the investment firm where Donald Trump Jr. works.
Yeah, so no conflicts of interest. I am curious, though. I mean, when you say big news on Fannie Freddie, obviously everyone's waiting for the actual big news, which is, what happens with this conservatorship and whether it's unending and whether we take these companies back into the hands of real investors here. Did he not touch on that at all?
I didn't say anything like that, and it seems like they're still waiting. So maybe that's why we're off its highs. But yeah, it's like everybody's kind of on pins and needles. So we're still waiting. TBD. All right, over to you, Tim.
Okay, let's start with some of the prominent decliners that we saw in today's session. Romain mentioned Meta Platforms dragging down the indices, falling by 2.2%. I'm keeping an eye on them after the FTC's antitrust trial got underway today. The FTC is seeking to break up Meta Platforms, and we actually saw Mark Zuckerberg take the stand earlier. The FTC is seeking to force Meta to divest Instagram and WhatsApp. It alleges that the acquisitions gave Meta this illegal monopoly on portions of the social networking industry. The trial is expected to last a couple of months. It's going to also feature testimony from former Meta executive Sheryl Sandberg. And I'm also watching shares of what happened with LVMH today. Here in the U.S., ADRs of LVMH fell by 6.4%. This after the company reported that sales of the company fell more than expected in the first quarter. This was due to weak demand for luxury goods in China and in the U.S., and there's a threat of a trade war, of course. The company's fashion and leather goods division, which is its largest unit, saw a 5% decline in revenue on an organic basis. Analysts were expecting only a decline of just about half a percentage point to 0.6 of a percentage point. LVMH is considering price increases to offset the impact of tariffs.
Price increases?
They've got room to adjust marketing costs. Wow. They don't plan to radically change U.S. production. They've got 75 brands. They don't call them brands. They're maisons.
Really? That's what they call them?
Yeah. 6 sectors.
AKA brands.
Fendi, Louis Vuitton, Tiffany, Sephora. This is like Romain's world. He's the luxury goods guy.
They're houses. So yeah, that's French, Carol, for
houses.
Yeah.
So 75 I
6 sectors. Is that like Hors d'oeuvres?
Okay.
Miss Escargot.
Okay, I like that.
The costliest dinner I ever treated someone to.
Finally, I do want to look at shares of DaVita. This is the kidney dialysis company. It fell 3% today. Fell more earlier in the session. It did become aware of a ransomware incident that has encrypted certain elements of its network. The full scope, nature, and potential impact on the company are not yet known at this point. Shares falling today by just about 3%.
All right, let's take a quick look at yields because we did see a lot of activity there. You see on the short end of the curve there, that was where most of the activity was. Down 11 basis points on your 2-year yield, 15 on that 5-year yield. And you did also see buying going on in the longer end of the curve, drops of about 10 basis points, on the 10-year, and then another 5 to 6 basis points on the 30-year yield. But again, really doesn't underscore the volatility that we saw in between here. Volatility, of course, that was also whipsawed around by some of those reports that we got out around 11 a.m. with that New York Fed survey showing inflation expectations amongst U.S. households continuing to creep higher as their outlook, Carol Massar, for their own economic conditions continue to drift lower.
Like, kind of interesting to see at least, that trade in the Treasury trade. But I got to say, I feel like we just kind of wait for the next shoe to drop. And, whether or not we're going to see something new, additional, lasting when it comes to tariffs. And I think it's a really difficult market environment to work within. I'm curious to see what the Treasury Secretary, Scott Bessent, has to say definitively. But can we even assume that we will have anything definitive when it comes to tariff strategy here?
I don't know the answer to that, but what I do know is that it seems like every day we get more news. I mean, how many of us woke up on Saturday morning thinking that smartphones and laptops were exempt coming from China to these 145% tariffs? And then we learned yesterday that, okay, there are going to be these sectoral tariffs for semiconductors, and these devices will actually fall under that category. So there is this sort of temporary reprieve for some of these large companies, including Apple, but it doesn't seem like this is the type of company that's going to escape unscathed.
Yeah, Carol, you mentioned definitive. It's definitive until someone else says something else, which is why people keep going to stores and loading up and buying what they can right now because they have no idea what could change in the next day or so. And a reminder that President Trump did hint that there was a possibility he would announce tariffs on semiconductors perhaps today. And, so far, we haven't heard anything.
Autos and auto parts, right?
Mm-hmm.
Yeah, that's the other thing. So then maybe this little hint earlier today that there would be exemptions for auto parts. But again, a new bit of news.
Yeah, but the question is, when do you get sort of some stability in these announcements? Because again, it's not really what the policy is. It's the question is that policy going to change in a few months? You're not going to get any company to make the type of investments that I think the administration wants to see unless they have some clarity that if they do this, they're not going to have the rug pulled out from them in a matter of days, in some cases, or months.
Yeah, how do you game this out, especially if it means investing or making investments or hiring people or what have you? I kind of keep going back to that. It's a tough environment. All right, folks, that's a wrap. Our Monday almost over. Our cross-platform coverage on radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. We will see you again, same time, same place tomorrow.
And with the market right now laser focused on policies coming out of Washington, well, we have a conversation with one of the most critical people in Washington, the Treasury Secretary of the United States, Scott Bessent, right now down in Argentina, leading Washington's trade war policy. A conversation with him coming up next, right here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. The volatility from last week, a bit tamped down here on this Monday afternoon. The VIX back below 30, and that gave a little bit of clearance here for investors to try to find some bargains and bid stocks back up. An S&P 500 closing above that 5,400 mark, up about 0.8%, with 431 of those names in the green. But it wasn't all roses, Scarlett. Of course, we saw a lot of pressure in the semiconductor space. That index at one point was up about 3%, closed higher by about 0.3%, but a little confusion here about what tariffs exist now, what tariffs might exist tomorrow, and that caused a little bit of a sell-off in the semiconductor space here. You also see some of those tariffs concerns reflected on the last line of your screen there. That's your Mexican peso here, strengthening in a big way for a second straight day by the equivalent of about 1.1%.
We've gotten used to seeing 1% plus moves in the dollar. It's pretty remarkable given that currencies don't tend to move like on this scale ever. And of course, this is kind of an indication of what's to come because we don't know what's going to happen with these tariff headlines. So let's bring in our next guest, Ethan Devitt, Senior Advisor and Market Strategist at Moneta. And as Romaine was just showing us on that board, we saw Treasury yields decline for the first time in a week. It really feels like the Treasury market is the tail wagging the dog here.
It has been for the last few weeks, and it does seem like that was actually the tipping point in terms of the pain point that caused the reversal on tariffs. Now the headline seems to be that this is a sign of recession predictions, that we're seeing this flight to safety in treasuries again. We've sort of temporarily suspended the narrative of forced selling or widespread selling of treasuries by our trading partners. So it's very difficult to know what to believe, but certainly reassuring, at least as far as the 10-year goes, that we are seeing some bid for it today.
Is there a sense here, Ethan, that even with some of the short-term moves, that there is more conviction in the long-term direction of this market and, for that matter, the economy?
I think we're certainly cheered to see the direction moving in the right direction. What market participants have been subject to recently is this, quite realistic game of virtual reality where we've been plunged into the worst case scenario, and now we are ratcheting back from that. And somehow the narrative we're getting is that this is a good thing, that we now know how bad it could be, and that our trading partners have been shocked into making phone calls, and that it will be better from here. I think we are seeing incremental rollbacks from the worst case scenario. So that, I suppose, is a positive thing. It would be surprising to see us dive back into that again, because I think we know a pain point or threshold has been crossed.
Yeah, we know the pain points thus far, but that could always change going forward. So having said that, where do you want to be regardless of what tariffs get announced or don't get announced?
You want to still be across the board well spread globally, because we know now from the last few weeks that global stock markets ex-US are starting to come into their own. We know one of the unintended consequences of this trade policy, and certainly the geopolitical standpoint we've seen, has been really a resurgence of spending in Europe, a resurgence of national pride, and really just a work around some of these tariff restrictions. So I'd say that having a global portfolio is more important now than ever. You just spoke about the dollar and its movements, its quite volatile movements of 1% plus. That's another reason to own non-dollar currencies. So that has not changed. And I would also think that having a portfolio that has some inflation resilience built into it has not changed, even though the headline on inflation was positive. We think tariffs do mean inflation is heading upwards.
What does that inflation trade look like right now, Ethan? Because you haven't seen a whole lot of activity in tips, which I know is probably the more direct way to play this. But I'm getting the sense that people are taking out inflation hedges, if you will, in other ways, other types of assets.
Well, there have always been ways, but equities themselves are a bit of a long-term inflation hedge, and we know that the retail bid for equities is still strong, and certainly some larger companies will be able to have pricing power and push that through. But the traditional inflation-resilient assets in a portfolio are real assets, real estate, some of those infrastructure names. And I would think with the spending and the verticalization of the US, the focus on spending internally, that is going to be very positive for infrastructure. We know that the public-private partnership around infrastructure has been growing, and that much of it is crumbling, and there is a need to invest there. So I think infrastructure stocks have not been that exciting in relative terms, but as bond yields come down, as interest rates come down, that dividend nature of infrastructure stocks could be quite interesting going forward.
And even quickly here, given that companies have been reluctant to share too much guidance, if at all, what do you reasonably expect to learn this earnings season once the management does start sharing their views?
I think we're going to hear a lot of those, the superlatives around caution on the horizon, whether it's an incoming storm, depression of consumer spending, all of these things that we really already know. And I actually don't think markets will be that surprised by that. I think we really have discounted in quite a bit of a decline in consumer sentiment and in corporate sentiment. I don't think any of that will be a surprise. What will be perhaps a surprise is something positive on the upside. So I do see earnings being depressed by this, but I don't think markets will be that surprised.
All right, Ethan, always appreciate the conversation. Ethan Devitt, Senior Advisor and Market Strategist over at Moneta. She was just talking about infrastructure a little while ago. Scarlett, we are getting some earnings out of Applied Digital. This is, of course, the digital infrastructure company, the company that's been helping to build out data centers for AI. The results are out, and, well, it's a big miss. Revenue came in at $52.9 million in the most recent quarter. The street was looking for 63.4. The company also reported a loss per share of about 8 cents. Now, that was actually better than the loss per share that the street was looking for, which was 11 cents. Nevertheless, some concerns here that maybe we are starting to see some cracks in that AI trade. Those shares down 7% in the after hours.
Yeah, worth mentioning as well, Applied Digital was the most shorted ahead of its earnings today as well. So that just gives you some context heading into these results. In terms of data that's going to come out, what'll be interesting is, including with earnings, this idea that a lot of people are buying things, we're front running the tariffs. So we might get a boost in a lot of the numbers, whether it's data or earnings, despite the fact that you have tariffs on the horizon.
Yeah, and you call it boost, I would call it distortion, right?
Yeah.
Because now how are we supposed to sort of make sense of what's happening? If Apple reports a blockbuster quarter because of this pull forward, is it a pull forward? Are we still going to buy just as many iPhones and other devices in the quarters going forward? So that's what's making things harder here. Of course, it's not just about the chaos coming out of Washington, but it creates chaos for markets as well. Markets that have been looking for resolution or at the very least some direction. Let's go down to Buenos Aires, where Anne-Marie Horton is standing by with the U.S. Treasury Secretary.
I'm pleased to be with Treasury Secretary Scott Bessent. This time you're back on Bloomberg in Argentina. Thanks for joining us again.
Good to be with you. Good to be in Buenos Aires.
Yeah, it's fantastic here. So you've come here at a time when the IMF has just announced this $20 billion agreement with Argentina, but we haven't seen a Treasury Secretary come to Argentina since Trump's first administration, and that was for a G20. So why the emphasis from the Trump administration on Argentina?
Well, Anne-Marie, a couple of reasons. The reason for being here today is today's a fulcrum day. So the Milei administration has done 3 adjustments, and this marks the beginning of the third one. So they did a large fiscal adjustment, a large monetary adjustment, and they're doing they announced on Friday a large currency adjustment. IMF has allocated $20 billion to them. The World Bank has allocated $12 billion. And I wanted to come here today to show support for President Milei and his commitment to what I think is historic in terms of bringing Argentina back from the precipice.
When it comes to the trade negotiations, I'm sure you spoke with President Milei about the 10% rate that Argentina was hit with. Do you think at some point that can come down to zero?
Look, I think we're going to start the negotiations, and just like with everyone else, I'm telling them, bring your A game, we'll see what you got, and we'll go from there.
Can any country go to zero?
We'll see. I don't know what's going to happen with the negotiations, because we've got a whole box of things we've got to overcome: tariff, non-tariff trade barriers, currency manipulation, and subsidization of labor and facilities. So there's a big menu there.
There's been an early focus on Latin America writ large from the Trump administration in the first 100 days. Is Latin America policy also, in a sense, China policy for this administration?
Well, I think that might be a good description, because what we are trying to keep from happening is what has happened on the African continent, where China has signed a number of these kind of rapacious deals marked as aid, where they are really, they've taken mineral rights, they've added huge amounts of debt onto these countries' balance sheets. It's undisclosed to any of the other international organizations. They've got tolling arrangements. So they're guaranteeing that future generations are going to be poor and without resources. And we don't want that to happen any more than it already has in Latin America.
China has a foreign exchange swap with Argentina. Would you consider a credit line directly from the United States?
That's not under consideration in terms of, so they have an $18 billion credit swap in RMB. Argentina, under the previous Peronist government, drew down $5 billion, and that will remain outstanding. The Chinese showed very good faith effort after the announcement, or in conjunction with the IMF announcement, so that is going to be rolled forward for a year.
But do you want them to get rid of that swap with Beijing?
Well, I think as this administration continues their stay the course on their economic policies, they should eventually have enough foreign exchange inflows to be able to pay that off.
So less than 2 weeks ago, you and I were talking outside of the White House after what the president called Liberation Day, and you said you weren't part of the negotiations. Now you're leading them. What's changed in these past 12 days?
No. What I said was I didn't construct the actual
tariff rates.
The tariff rates. I've always been part of the tariff policy. I had been focusing on tax. Maybe you want to talk about that later. That's going very well. And now with the trade negotiations, I'm going to be part of that. And the president has hit a 90-day pause button, and we are moving quickly with many of our most important trading partners. So we had Vietnam in last week. We had Japanese in on Wednesday, South Korea next week. So it's going to move fast. And but the important thing for your viewers to know is we're setting up a process. And we are going to run that process. It's going to be orderly. And at the end of the day, especially for the most important trading partners, the president's going to be involved.
So when it comes to the current negotiations this week, you're also sitting down again with the Spanish negotiating team, the Japanese negotiating team, and also the Spanish economy minister? Well,
the Spanish economics minister was just a prearranged meeting. He and I have never met. So that is not a trade sit-down. The Japanese meeting is a trade negotiation.
The Japanese prime minister recently said he's not going to rush to get a compromise and a negotiation. How quickly do you think you can see these deals come to fruition?
Well, again, I think there will be advantage to our allies, especially in a first mover advantage. Usually the first person who makes the deal gets the best deal. So
who do you think will be first?
It's their choice.
Is there a handful of countries that you expect to have a deal before the 90 days is up?
Oh, I think there could be numerous countries. And look, it may not be the actual trade document, but we will have an agreement in principle and be able to move forward from there.
So are we talking about a dozen or 70 plus?
Look, I think it's going to depend, but we're going to move with all deliberate speed. And again, it's going to be a process. It's going to be USTR, who just has mountains of data that they've been collecting over the years. Because in a funny way, the tariffs are the easiest part. So a country with high tariffs, you can just say, okay, this, get rid of it. It's the non-tariff trade barriers that are more insidious, more difficult to spot. And it's probably going to take a little longer to exercise those demons.
When you said you weren't part of the rates in that chart that the president held in the Rose Garden, is he taking a maximalist approach? Neil Dudder recently wrote that President Donald Trump has cracked a lot of eggs, and now Scott Bessent, the Treasury Secretary, needs to make an omelet. Is that how you view this situation right now?
I view not giving away negotiating secrets on worldwide television as the essence of negotiating.
You recently talked about getting deals done quickly with partners to then confront China together. When you're in these negotiations with trading partners, are you looking for them to offer up something to combat Beijing?
Well, I think combat's an aggressive word, but look, I think now that we have the China tariffs in place, that they are going to want to have some protection from Chinese goods flooding their markets. That China's business model is like from that Disney movie where the brooms are carrying the buckets. Like they're not going to stop manufacturing because the U.S. has a tariff wall up, so those goods are going to go somewhere.
Where do you think they're going to dump?
Well, I think it depends on the good.
We have exemptions now, though, for electronics, so we still expect electronics to come into the United States with the smaller tariff rate, the fentanyl, 20%.
But you were asking where are they going to dump? I think it will depend on what is the good. You know, higher value-added manufacturing goods, likely in Europe, Canada, in the G7, and then kind of more of the baubles and knickknacks in the global South.
China's Commerce Ministry came out when the tariff rates were going above 100% and called it, quote, a joke. Has there been negotiations on any level between Beijing and Washington right now?
Well, look, it'll come from the top. President Trump, Chairman Xi have a very good relationship. And I wouldn't say that these are not a joke. I mean, these are big numbers. I think no one thinks they're sustainable, wants them to remain here, but it's far from a joke.
Well, they just say that the rate is so high, it's become a joke. Basically, does it just stop trade between Washington and Beijing altogether? Do you see a decoupling of these two economies?
Well, maybe the trade minister has a different sense of humor I do, but I don't see anything funny about it.
Do you see a decoupling, though, between Washington and Beijing?
There doesn't have to be. There could be. There's a big deal to be done at some point, but look, what is different with China that is different in the history of trade, that normally, if you go back to the big trade deals or the currency deals in the 80s, the Plaza Accord, the Louvre Accord, the Reagan auto deals, our leading economic competitors were our military allies. China is both our biggest economic competitor and our biggest military rival. So that's going to require a special kind of formula.
Are you teasing out a Mar-a-Lago Accord that we should be paying attention for in the future?
I'm not sure what you're talking about.
Well, potentially getting all these trading partners together to discuss fair, balanced trade?
Well, we're doing that over the next 90 days.
Okay. So shifts in tariff policies has had markets on edge. Even the president recently remarked that the bond market was, quote, queasy. Do you have a sense of who is dumping U.S. assets? Who's been dumping U.S. treasuries?
I don't think there's a dumping, and I think we saw in the TIC data either today or Friday that actually foreign ownerships picked up. We had two we had 3 big auctions last week, and on the longer end auction, 10-year, 30-year, we saw increased foreign competition. So I actually think this is one of those occasional VAR shocks that you get in the trading community. I think a lot of people got very leveraged, maybe out over their skis, and then you combine that with some real money selling, and you get these moves.
So you don't think it's sovereigns, potentially it's hedge funds unwinding?
I have no evidence that it's sovereigns. And look, Anne-Marie, not you, but the nature of journalism is to create a headline that 10 days ago, when 10-year yields hit 3.90, said, well, Secretary Bessent got what he wanted. He got 10-year yields down, but it's the wrong reason. Now, I forget what they hit on Friday, maybe 440 something.
We saw a 50 basis move last week in 10-year yield. At the same time that the dollar was weakening nearly 3%. How do you simultaneously look at that situation? It feels like investors are dumping U.S. assets.
Well, look, I've learned that not to look at what happens over a week. Right? Like, I, for better or worse, have lived through a lot of these things, and in trading, in one's personal trading history, it's the scar tissue that sticks with you the most. I can tell you exactly where I was standing in 1998 when the long-term capital, the debacle happened. That had nothing to do with anything other than a bunch of geniuses up in Greenwich who had too much leverage.
So you're not concerned at this moment about the U.S. dollar or the U.S. Treasury losing safe haven asset?
No. Look,
we're still a global reserve currency.
We are still a global reserve currency. We have a strong dollar policy. The dollar can go up and down. If you go and look back at President Trump's first term, I don't remember the exact number, but the dollar in 2017 went down, I can't remember, 7, 8, 9%, and then once the tax bill was done, took off for the remainder of his term.
Have you spoken to the Fed at all about contingency plans, though, if financial stability risks flare up?
Chair Powell and I have breakfast every week, and we discuss a wide range of things. And our staffs are always in contact. We have a markets room, they have a markets room, but and specifically, did we discuss some kind of a break the glass? I think we're a long way from that.
So when was the last time you guys spoke? You had breakfast last week?
We had breakfast last week, and it was an away game. I was over at the Fed.
And no concern so far from the Fed chair on what he saw in the Treasury market?
I think we would have heard from the Fed chair. I think we heard from Governor Collins of Boston on Friday. We heard from Governor Weller today on his thoughts on what tariffs mean. So it seems like business as usual.
When it comes to the Fed chair, his term is up May 2026. So we're almost 12 months out from that. When are you going to start to think about and have these discussions with the president about who should lead the Fed?
Well, we think about it all the time. I think when are we going to start the interviewing candidates? And that'll be sometime in the fall.
In the fall, so about 6 months lead time.
Yep.
The U.S. Supreme Court recently came out with a ruling that the executive branch, the president for now, could oust top officials at independent agencies. And that has some individuals in the market a little bit concerned about what this could mean for the independence of the Fed, which is really a cherished pillar of wanting to invest in America. Do you have any concern about potentially President Trump ousting Fed Chair Jay Powell or the independence of the Fed?
Well, Anne-Marie, I've repeatedly said the Fed has two duties. And I believe that monetary policy is a jewel box that's got to be preserved. And then they have regulatory policies. And I think we can have more of a discussion because the Fed is one among three bank regulators. And there's the Fed, Controller of the Currency, and the FDIC. So I think it's very easy to delineate between those two.
So at the moment, no concern?
No concern.
When you talk to Fed Chair Jay Powell, at the moment, it doesn't sound like they feel like the need to step in on this unraveling we saw last week with the bond market. Does the Treasury have any plans to do something if this was to become more unnerving?
Well, look, the Treasury has lots of things we can do. And but again, I think we're a long way from that.
but all options would be on the table?
Sure. But again, we have a big toolkit that we can roll out. We do regular off-the-run buybacks. We could up the buybacks if we wanted. So.
Just finally, I want to get your thoughts on something you told me, John, and Lisa in February, which was that in your old world, you would be that person with your ear against the door trying to understand what policymakers were doing so then you could predict where financial markets would go. In this moment where we hear from top executives constantly, today it was the Goldman Sachs CEO, last week it was Jamie Dimon, and this uncertainty, especially around tariff policy, what advice would you be giving to your old self?
To look at the whole policy, because, again, not you, but others in the media can pick one factor. So right now it's tariff, but we have, you mentioned we have tax coming up. We have deregulation. So it's a mini the leg stool, and I would try to think about what's happening. The tariff sequencing was always going to be first. The tax bill's going very well, and I think I've been pleasantly surprised at how quickly that's moving along. And then deregulation from our area on the financial side and in the rest of the economy, that takes a little longer, but that will start kicking in September, October, in the fall, and those are going to be very powerful.
I believe you described as a three-leg tool, and right now everyone is focused on one part of that leg, and that's the tariffs, as you say. But when it comes to the tax cuts, right now what the market is expecting and what could get done in Congress based on how slim the majority is for the Republicans is just an extension of current policy.
I think that's wrong. I think that the underreported story in the media, the story this funder report doesn't get reported enough is the Democratic chaos, but the underreported story is the remarkable Republican unity led by President Trump. Speaker Johnson, on first try, got instructions out of the House for the budget. He passed a clean CR first try. Leader Thune pinged it back to the House very quickly with their instructions, and I had something along with Kevin Hassett, had an NEC chair called the Big Six, which also includes Leader Thune, Speaker Johnson, Senator Crapo, Committee Chair Jason Smith, and everyone's very aligned, and there's going to be a lot more bells and whistles other than just changing the date on TCJA.
So your pitch right now to financial market participants, to consumers, is you need to see the entire picture.
You need to see the entire picture, and as President Trump said the other day, stay cool. It was my message when I was out with you on April 2nd. It was to the countries. These are maximum rates, so you ask if it was a maximal strategy. If you don't elevate, this is your maximum rate, so don't elevate. You have, in markets, the upside barrier. You don't have unlimited risk, and then come to us, and we will negotiate in good faith.
Can you guarantee clarity in 90 days?
I think clarity is through the eye of the beholder, but I can guarantee you that we're going to run a robust process, and I think the market can take great comfort in that.
So maybe some of that uncertainty starting to evaporate.
Yeah, if we measure uncertainty by the VIX, I think that the VIX, I don't want to make market calls, but I think that the VIX spiked and is likely peaked.
Secretary Bessent, we really appreciate your time. Of course, that was Scott Bessent, the U.S. Treasury Secretary here in Buenos Aires. And his pitch to the world, it's a three-legged stool in terms of Trump administration's policy proposals. Right now, the market squarely focused on tariffs.
All right, thank you so much. Of course, U.S. Treasury Secretary Scott Bessent speaking exclusively with Bloomberg's Anne-Marie Hordern in Buenos Aires. And there's a lot to pick apart there, Romaine. I really liked Anne-Marie's question about can you guarantee clarity on tariffs within 90 days, because that was the pause period that President Trump announced. And what he did say was, I can guarantee we will run a robust process. Come to us. We will negotiate in good faith.
All right. Well, it'll be interesting to see when we get there. You also heard his response to one of our last questions, and apparently that's all in the eye of the beholder as well. I thought some of his comments about the Treasury sell-off last week and how he's saying that, look, we didn't see that type of foreign selling, something that we've seen a few Wall Street strategists point out that there actually was more of an inbound of foreign money coming into the market.
Yeah, according to the TIC data.
According to the TIC data. And of course, according to him, in his words, there was no sort of break the glass moment last week when it came to the stability of the Treasury market.
And there's no evidence, or at least he has no evidence of sovereigns dumping U.S. Treasury.
Of course, a bigger issue, of course, is what's happening in capital markets. We should point out a headline crossing the wire right now, this involving ON Semiconductor. Remember, we had learned just a couple of weeks ago or last month, I should say, that they were going to make a bid for Allegro Micro Systems. This was going to be about a $7 billion deal. We're now learning today, right now, that ON Semi has withdrawn that proposal. And it's a nice setup into our next guest here, because when we talk about the sentiment in markets, we have to talk about the sentiment in the C-suite and whether that sentiment is actually conducive to deals, particularly in the private equity space, as deal making slumps to start the year, despite some reprieve from tariffs. Our next guest says, quote, "We've been here before, and companies will just need to be exit ready on demand to find windows of opportunities." Nick Lepper joins us right now. He's a founder and CEO of a company called Accordion. It's a financial consulting firm that's focused on the private equity sector. Thanks for joining us, Nick. And I am curious about how folks feel right now. When you talk about being at the ready, I feel like a lot of these companies have kind of been at the ready now for the last couple of years. This was supposed to be that moment, and at least for right now, it's being usurped by some of the drama going on with regards to tariffs.
Yeah, no doubt. Well, thanks for having me back on the show. Always love being here. The private equity industry went through a time last year where everyone was expecting deal flow to happen, and then it just came to a real lull, and everyone expected 2025 to happen and be super active. I think now, given the uncertainty, and uncertainty is anyone who has a crystal ball is only really one person here, but everyone else is trying to figure out what happens in deal making. When we talk about getting companies exit ready, that's the key. Nobody knows when deal making is coming back. We have a good view that it will likely come back in the back half of this year. There's too many tailwinds at play that get behind the idea that there's going to be a lot of deal making. LPs are looking for companies to exit some of the longest hold periods that we've seen in private equity.
Right.
There is a ton of dry powder, more dry powder in private equity funds than ever before in history. That needs to be put to work. And there's a lot of pent-up demand of just getting back to deal making. But in lieu of that, you need to do other things. You need to prep the companies for sale. And we're advising clients to do two things: to focus on tariff impact analyses and real sound liquidity management strategies right now.
I am curious on the liquidity side, because, you bring up the LPs. The LPs are putting pressure on these companies for a while now. I remember even last year, about a year ago, there was a lot of pressure on these companies. That was before all of the chaos that we got into here. Is that going to be the catalyst that finally gets some of these firms to take liquidity more seriously?
Yeah, I think there's reality happening. The average hold period is longer than 6 years right now. When you think about private equity hold periods, that's typically 3 to 5 years in total. And so now you're looking at 6 years. So the pensions and the endowments, they're all looking for liquidity back. The GPs are looking for further commitments to their next fund, but also they have to put money to work that they already have in the coffers. So right now, a lot of the private equity funds we're working very closely with are focused on what can we do right now from a value creation standpoint, focus on this quick wins, focus on navigating this very rocky time, and then be at the ready when the market comes back.
So, Nick, I want to follow up on what you said about PE-backed companies will need to show sound liquidity management. What does that look like when we don't know how much the economy is going to slow, whether there might be a recession going forward?
Yeah, no one knows right now. What's great is this is not indifferent from spring of 2020. There's still a lot of the best practices around cash flow and liquidity management that every CFO, whether it be private equity backed, non-sponsored, or a public company, has to employ. So those are things like 13-week cash flow forecasts, but not your traditional treasury inputs. Then getting down into the operations, look, how do we free up cash? That's divest of non-core assets. And so understand how can we free up cash that way? It's looking at things like our AR and our AP processes. It's looking at automation to drive more efficiency. And then equally, when it comes to sourcing and tariffs, looking at where we're sourcing product from, looking at vendor contracts and timelines, and seeing what opportunities may exist there. And we're spending a lot of time on tariff impact analyses and mapping out a strategy. In a state of uncertainty, you don't necessarily know what's going to happen, so you need to be able to scenario plan all these opportunities out.
For those companies that are publicly traded, does that mean less use of cash in, for instance, share buybacks or dividend payouts?
Yeah, I think, a lot of them, let's just focus on more of the operational side. I think, a lot of public companies and private companies are really looking at where we're sourcing. Is reshoring actually going to happen? What are alternatives to China? Treasury Secretary just mentioned Argentina. That could be, a rate-free zone, and then that could be a really great alternative sourcing place. Other sponsors focus on the what-if scenarios. I'll call them the so what. If tariffs go to X, then we'll do Y, and mapping all those out and getting your partners ready for that. And then ultimately looking for exemptions in the tariff strategy. Things like, if you are transforming or producing goods that more than 20% in the US, you can claim that as exempt. And ultimately, companies are getting more and more creative on labeling things made in America to forego the tariffs. So companies are getting very creative in what they can control versus what, the broader decision-making body can control.
So this gets us to when we kind of circle back, Nick, and this idea that whether financial market conditions will be favorable, and for that matter, economic conditions as well. Suppose that we don't get the most favorable conditions. Is there an alternative? Because we've seen, I guess, a lot of exits to a certain extent, just not in the traditional way. It's more just basically passing one private company off to basically another private holder here. Is there more optionality in that space right now should public market conditions not be favorable?
Yeah, I think there's, again, there's a lot of tailwinds here of where deal making should increase. Everyone's been sort of kicking that can down the road for a while. I mentioned dry powder's at an all-time high. They are now looking to deploy capital, return capital to limited partners. And, a lot of sponsors are looking at more creative ways, whether that be roll-up strategies and building from smaller companies into private companies, or deploying capital into carve-outs. I mentioned corporates freeing up cash by divesting non-core assets. Those can ultimately be, standalone private companies. And so that's always been of interest, but even more so in this environment.
All right, Nick, really appreciate your joining us and sharing some of your thoughts with us as we get through this turbulent period. Nick Leppard is CEO of Accordion. Now, of course, when we think about the bigger picture here and the macro backdrop, year-ahead inflation expectations are rising. And in fact, they did climb to an 18-month high, according to the New York Fed's latest survey of consumer expectations. This comes as Fed Governor Chris Waller expects the tariff impact on inflation to be temporary. For more on what this all means, let's go now to Omer Sharif, founder and president of Inflation Insights. So, Omer, this is another piece of data that backs up the idea that people believe inflation will increase, at least in the near term. But unlike the University of Michigan data, people don't necessarily see that lasting beyond 1 year.
Yeah, I think the inflation part of the New York Fed survey today was, frankly, was a little bit of a relief. It did not corroborate what we've seen in the Michigan numbers. The 1 year did, as you said, started to creep up a little bit. It's an 18-month high, but that number was, nearly 7% back during the middle of 2022, and realized inflation was also spiking. So right now, really, the Michigan 1 year and even the 5 year is sort of, out of left field. We don't really have anything else that's corroborating Michigan. But quite frankly, I don't think it was the inflation story, to me, wasn't really the main story out of the New York Fed survey today. It was, what people are feeling about where unemployment's going to be a year from now, how their financial situation is going to look. Those numbers deteriorated quite a lot. And frankly, that's exactly what we're seeing in Michigan as well. So I think that was actually a much more concerning part of that report today versus the inflation data.
So what does that mean when you marry it to what you expect to hear from companies as they announce their results and look ahead to the months and quarters to come? How will you interpret the guidance that they do offer when so many consumers are worried about employment prospects?
I mean, we'll see how much guidance we get. As you know, Delta obviously, essentially is not really offering any guidance for the balance of the year because they don't know exactly how the tariff story is going to play out, what it means for travel demand, over the next several months. So we'll see how that goes. But I think the concerning part of the data today from the New York Fed is that, we've, I think, all been really focused on just figuring out what is the inflation impact of these tariffs. And I think everyone has sort of forecasted this domino effect where tariffs go up, people get hit on their disposable income, they pull back on spending, then you get layoffs and the unemployment rate rising, and all of that the weakening labor market comes much later in the year and the inflation impact comes first. I still think that's largely the case, but I think people are sort of front running these tariffs. We've seen that with auto spending in March skyrocketed. People tried to get ahead of these tariffs. But if people are talking about how concerned they are about losing their jobs, the inability to get a job in the next few months if they lose it, that suggests we need to be on the lookout for a much faster pullback in spending. We're not quite there yet in the hard data, but I think that's the biggest concern out of today's numbers.
I am, though, curious, too. We talk about the psychology and how that feeds into expectations. I should just point out, I buy a lot of stuff online, Omer, and I've been getting a lot of alerts from these companies I bought from, basically saying, hey, you should re-up on whatever, whether it's new shirts or whatever, specifically because of tariffs. So basically, they're not saying it explicitly, but kind of saying, look, if you don't buy now, prices will probably be higher sometime in the future. And I do wonder, when we talked about this idea of front running, how much that plays into it and whether that is something the Fed could even fight back on right now. If companies have basically seized on this and consumers are being scared about this, has the Fed basically, lost the anchor, if you will?
Well, I would say they haven't lost the anchor on the longer run inflation expectations. Again, those numbers outside of Michigan, everything else remains relatively stable. The New York Fed today, stayed pretty flat around 3%. But I think this front running is occurring. Again, we saw it very, very clearly in new vehicle sales. And what you were mentioning here about, getting these emails about buy it now before the price goes up, we're seeing that in wholesalers too. So one of the areas that's going to be hard hit from the tariffs is, furniture and household furnishings, kitchen supplies, utensils, things like that. A lot of that stuff comes from China and places in Southeast Asia. We know from looking at some of those companies that they've sent out notices to their retailers. So the wholesalers have sent notices to retailers saying, hey, March 18th, April 2nd, prices are going up between 8% to 15%. So we know that is occurring. We're seeing that, start to bubble up in some of, I wouldn't call that hard data necessarily, but we've seen those letters come out. We're seeing now, for example, wholesale used vehicle prices in the last week of March and the first week of April spiked very significantly. Mm-hmm. And the other sort of telling point here is at the auction, these used car dealers are just loading up on inventory right now. Typically, when these cars go to auction to sell, the selling rate is maybe 60, 65%. The last few weeks, it was 100%. Everything that came into the lanes was being bought because they're stocking up knowing that prices are going to go higher. So we are seeing these signs start to build. We saw it in the PPI last week. I know people don't really dig into that one quite as much. But these steel aluminum tariffs, steel prices for primary steel products went up 10% in the last 2 months. The March increase was the highest since 2022. Aluminum prices. So we are seeing some hard numbers start to bubble up. And again, other signs in some of these letters being sent out saying, hey, prices are going to go higher.
So then it gets to this idea then, if we do start to see, consumers sort of rattled to the extent that they are willing to kind of keep their wallet in their pocket, so to speak, Omer, is there a sense that just like we get this snapback in financial markets when Trump or someone in the White House says, okay, look, the tariffs are off and okay, it's off to the races again in the market, is that light switch going to be as quick when it comes to the consumer as well and how they feel about things?
Yeah, I'm a bit skeptical of that. Again, I think in part because of the environment, the markets might rebound, and we've seen that on the electronics pullback now with the auto parts stuff today. But I think consumers are much more worried about the general environment of the labor market. This isn't the 2021, 2022 labor market where job openings were through the roof, where wage growth, importantly, especially at the lower end of the spectrum, we had double-digit year-over-year wage growth for leisure and hospitality workers. That's just not the labor market we're in today. Hiring has slowed to a crawl. We're seeing corporate layoffs, increase. So I think in general, if we do get some pullback on the tariff news, that's good news. But to me, that's more about sustaining the slow pace of spending. I wouldn't necessarily expect a big rush back, from folks going out to spend, because I think those labor market concerns are here, and it's just a very different labor market than it was a couple of years ago.
All right, Omer, great stuff. I have to leave it there. Omer Sharif, founder and president of Inflation Insights. As we look back, of course, at the inflation data we got and ahead to some of the inflation data we might get, and in between all that, a retail sales report that might shed some light here on just how healthy the consumer is. When we take a look at the wholesale space, there is a gauge of U.S. trucking and logistics stocks, and they've actually been up over the last couple of days, up about 2%. A welcome sign after dropping just below 20% threshold since the start of the year. JB Hunt set to report results tomorrow. Let's bring in Thomas Black, who helps to cover this space for us over at Bloomberg Opinion. And Tom, I am curious about, kind of the pull forward that we've been talking about. We've seen a lot of people rushing out to buy cars and phones, even paper products as well. I am curious if that actually feeds into an earnings report like we're going to get from JB Hunt, or are they kind of so outside the realm of this that we shouldn't care?
We'll see an impact from that, especially through the container imports that come through our ports and go on railroad, and a trucking company like JB Hunt, which is a big partner with BNSF Railroad. We saw those imports increase. There was definitely a pull forward, and what's unclear is how much that's going to continue, but we'll see that in the quarterly numbers.
How much clarity would they be able to provide, or are they at the mercy of whatever customers are doing, the merchants are doing in terms of pre-ordering and front-running some of their inventory buildup in order to avoid tariffs?
What's interesting is we're in bid season right now in trucking, where when you have long-term contracts, these are being settled right now. So those talks are probably very interesting right now. We're probably JB Hunt probably has some insight into what retailers and other shippers are thinking. So analysts and investors will be eager to hear what they have to say about that. This is, again, all about going forward. The first quarter is almost meaningless in a way. We kind of know what happened. Rates were starting to trend up as we saw that pull forward, but they've pulled back a little bit. They're still about where they were a decade ago, but certainly we've had a lot of inflation in the trucking industry, so the profit margins are being squeezed.
All right. Thomas Black of Bloomberg Opinion, who covers industrial companies and transportation companies. And of course, JB Hunt will be reporting earnings after the closing bell tomorrow. And as we push ahead to what could move the markets over the next 24 hours, that does include some additional earnings in addition to JB Hunt, Scarlett, including from a couple of the other big U.S. banks. Yeah, Citi, Bank of America. And I guess we'll be looking for more signs that equity trading really had a renaissance over the past quarter because of the volatility ahead of tariffs. We're also going to get Johnson & Johnson, and don't forget United Airlines, of course, on the heels of what we learned out of Delta. Should be an interesting read here on the health of the consumer, and for that matter, maybe to a certain extent, the health of business spending as well. At 8:30 a.m., we're going to get some interesting data on the manufacturing sector. Yeah, Empire Manufacturing, which measures New York manufacturing, and that's expected to be a negative number, which shows contraction. We also have U.S. import and export prices coming in. And that's the number I'm more interested in, too. That'll be an interesting barometer here, given all of the concerns about trade. We do get some Fed speak, this time from Fed Governor Lisa Cook. Can she say anything to actually soothe this market? Wait and see. Wait and see. Wait and see, Scarlett. I think everyone wants to hear from Jay Powell, and assuming we've got to wait and see for that as well. Also, I don't know, Scarlett, if you've actually filed your taxes yet, but tomorrow, April 15th, is the deadline to do so. I filed my request to get an extension. Yeah. So that counts. Yeah. I'm just holding off to see if they abolish the IRS, and then maybe I don't have to follow up or something like that. So anyway, thanks for joining us here, and please file your taxes. Don't want to get you in trouble. That does it for The Close. Balance of Power is up next. This is Bloomberg.